Hello, everyone. I'm Sandeep Tyagi, CEO of ST Advisors and Gulaq. We are going to go through the July rebalance, which has just happened for the month of August. And I'm here to answer any questions about our investment products for retail investors from Gulaq. Let's get started. I hope you can see my screen. Quick introduction about ST. ST is a company focused solely on systematic and algorithmic trading and investments. We've been around for 14 years. It's the year that SEBI first allowed algorithmic trading in India. We operate in multiple countries, mostly emerging markets and United States. We also were the institutional member of the year in 2019, which is the last time NSE gave out that award. And we have AUM of over 1,000 crores. Now, specifically Gulaq, which is what this webinar or call is about, is our retail investment advisory product. So we build model portfolios using quantitative models and make it available to investors who can then implement it using their own brokerage account. So if you have a brokerage account with Zerodha or Grow or HDFC or anybody else, you could simply take our research and implement it on your own using the brokerage account you have. Now, we have ways of customizing it to your specific needs based on the risk tolerance you have and changing the gear allocation or asset allocation based on that. The advisory portfolio that we have was launched in 2020, but really the full approvals and with the SEBI were received about 18 months ago. We have served over 4,500 people in this time period. It has built a multi-factor algo-based investment strategy that's available on platforms like Smallcase. Here is the team. As I mentioned, I'm Sandeep Tyagi. I'm the founder and CEO of ST as well as Gulaq. I'm an engineer, computer science undergrad, and finance MBA. And I've been doing analytical work for about 30 years. Vivek Sharma, who does these calls very often, is the head of investments at Gulaq. He has 20 plus years of experience in trading and management of investments, and he's got a BTech and MTech from IIT. And Isha Gupta, who is a business manager with us at Gulaq, has 5 years of experience in consulting and MBA from Indian School of Business. Now, we need to mention that we are a SEBI registered investment advisor. Here is our detail, the address. Investments are risky. They are subject to market risks. And of course, if anybody has any comments or questions, they can approach our registered address as well as our membership with various regulatory bodies. Now, how does Gulaq work? We don't just look at the most popular factor. You know, a lot of people talk about momentum investing, or they talk about value investing, or they may have a theme about a particular sector, consumer discretionary or infrastructure or rural Bharat, or these are all themes. We don't look at the market in any specific segment or theme. We look at all possible ways of looking at the market, and we evaluate it in 130 different ways, as well as 18 macroeconomic factors that we analyze. Together, we create a view of what the markets look like and base our portfolio recommendations on that. Now, even though we are evaluating over 130 factors, we don't use all of them all the time. We rotate factors based on what has worked recently, as well as what kind of a macro regime are we in. And historically, in those macro regimes, And macro regime means what is the interest rate? What is the inflation level? What is the price of oil? What is the gold price? What is going on with any major macroeconomic factor that can impact the performance of a company, its profitability. And we decide based on that which factor to use. Then the way we combine these factors has been tested over 15 years of historical data and is very robust and does not change month to month. So, we don't get greedy, we don't get afraid. Emotions have very little to do with the way we run our strategies. Now, all of these factors, as I mentioned, over 130 of them, they could be type of investment factor like momentum, value, low volatility, growth factors. They could be market cap indicators like, is it a large cap stock, mid cap, small cap? They could be sector indicators like FMCG, IT, utilities, healthcare, IT, real estate, financials, or they could be other aspects of the market, like is this part of the Nifty 50 index or not? What are mutual funds doing? Are they buying the stock, selling the stock? What is happening to the market microstructure? Are there lots of puts on the stock in the market? Are there lots of calls on the market? What is the discount or premium for the future to the cash market, which is an indicator of how bullish the market is about that? All of these factors together are evaluated. That gives us a balanced portfolio. Now, why is this important? First, no one factor always performs well. This is a chart which shows you how of the main factors between value, alpha, momentum, quality, and low volatility, what performed well in a given year. I don't expect you to read everything, but if you just look at the colors, is there any pattern? Can really anybody figure out what is going to work best in the next year in 2023? It's impossible because the colors keep changing, and that indicates that different factors will go up and down all the time. Okay. Similarly, if you look at which sector will do well, again, same point. There is no one sector that consistently outperforms the other sector. Sometimes IT is on the top, sometimes it's on the bottom. Real estate is on the top, it's on the bottom. Same with every sector. There is no pattern one could decipher, except that it keeps rotating. So having any kind of a thematic approach, whether it is momentum investing, sector investing, small cap investing, only works part of the time. And that's not a very robust way for building a model, which is why we focus very much on building multi-factor models. So some of the questions have started coming in. We have a question on, say, can you throw some light on the last month performance for Gear 6? Gear 6 is our 100% equity product on small case. Let me see if I can pull up the track record there. Okay, so these are the results for Gear 6. Blue line represents the performance of our model portfolio, including what happened in July. Orange line represents the Nifty multi-cap, which is the top 500 stocks in the country. So since May of 2020, investment in Nifty multi-cap would have yielded 100 investment becoming 225, whereas in our model portfolio, that would have gone to 435. Now, if we break it down by month or year by year, you can see in every year, our model portfolio has done better than what the index did. And in 2023, overall, we are almost 25% return for the year, whereas the index is only up about 10%. So very robust and consistent performance is what we have seen historically on our 100% equity portfolio. By the way, there are other portfolios available, Gear 5, 4, 3, 2, 1. And the difference is asset allocation. How much money we put into the stock market versus fixed income is what differentiates a gear 2 to a gear 5, and depending on your needs, what risk tolerance you have, what financial needs you have, the right level of asset allocation for you can be different. There's another question here from Karan, who's asking, are the markets overvalued right now? Now, we do not take a position on month to month whether the markets are overvalued or not. And frankly, we don't think that's a very easy thing for anybody to predict on. There are many quotable quotes, but one of which says, it's basically stock market prediction. The only job it is to make astrologers look actually scientific. So it's not an easy job. We don't think anybody can do it with any kind of a precise measure. However, one thing is important to note. If you are investing regularly, and for example, over last 6 to 12 months, the return in Gear 6 has been very high. It has been outperforming the index a lot as well, which would mean if you have invested in Gear 6, your portfolio or equity markets would have grown quite a bit more than what your fixed income investment would be. So you may have to rebalance. But we can't really tell you month on month basis, is it going to go further up or is it going to start coming down? We don't have any views on things like that. Okay. There is another question here, which is very similar. What should be my expectation in terms of outperformance, given that Gear 6 has generated huge alpha in the last 3 years? When we have tested our technology over a period of 15 years, we notice that it sometimes outperforms, sometimes is the same level of performance, and sometimes even underperforms on a month-by-month basis or even on a quarter-by-quarter basis. In the last about 3 or even 4 years, the outperformance has been tremendous. This is not what we would expect on a long-term basis. And if you come in looking at this kind of an outperformance and say this is going to be what I expect to do, maybe you are going to be disappointed. We think over long periods of time, a very systematic model constructed well in a balanced way is going to outperform the index potentially by about 5 to 6%. Nobody can predict what will happen in the future, but our historical testing results would indicate that. By the way, I can show you another chart which will tell you a little bit more about this. So this is our performance relative to the index. The blue line is our model portfolio. Orange line is the index portfolio. If you look at 3 months rolling return, and rolling return means you average returns for 3 months and put them together. So right now it will be the return for July, June, and May together. Now, as you can see, even on 3-month basis, sometimes the blue line is above the orange line, most of the time, but sometimes it is below. So you will get periods of 3 months, quarter, where our model will not be performing as good as the overall index. But in aggregate, it is doing quite well. Same thing if you do on a 1-year rolling basis. Now the blue line is almost consistently above the orange line. So patience is very important, but having unrealistic expectation is simply setting up for disappointment. So outperformance of 25%, 15%, which is what we have been having, is not something that we could realistically continue to expect ongoing. Simran has a question, in terms of volatility, how do you compare your portfolios to benchmark? So overall, our Sharpe is almost 3 times that of the benchmark. Index volatility tends to be somewhere around 15 to 20%. Our volatility tends to be a little bit lower than that. Our outperformance tends to be a little bit higher than that. So we have higher return than index, slightly lower volatility than index, not that much less, but about comparable or slightly less. So that's the comparison we have in terms of performance of our portfolio versus the index performance. And by the way, that's the right question to ask. how is it compared to the benchmark? Because if you're going to compare it to something completely different, like an FD, that's not a fair comparison because FD doesn't go down. You know what returns you're going to make. It's only going to go up. So you cannot compare investment into equities with investment into fixed deposit when you are looking at volatility or return comparison. Okay, another question here. Brijesh Ajoria has asked, I'm subscribed to Gear 6. It has high turnover. So want to know what are the effects of churning and tax effect on net returns. We certainly put in the transaction costs and we have tested the portfolio to be optimized with the returns. Now, the way we do it is a small part of our allocation is done to what is called our annual model, which means some part of your Gear 6 is being held such that your positions will be there for a year. You will get long-term tax benefit on it, won't have to pay short-term capital gains tax. However, it has been our conclusion based on our research that the outperformance you can get by rebalancing your portfolio on a monthly balance is more than the tax gap or the tax costs you're going to pay by paying short-term capital gains instead of long-term capital gains. So you are right. We do churn about 20% of the portfolio every month, which is compared to many buy and hold investors, more churning. However, we believe that allows us to perform well. So when you invest in Gear 6, that is something you need to understand that for bulk of your portfolio, you will be paying short-term capital gains and you would be paying commissions. So actually implementing something like Gear 6 on a full cost brokerage is not a good idea. Some of the full cost brokerages charge so much commission that maybe you won't make much money at all if you were churning this much using that. However, there are brokerages which don't charge any commission brokerage on a on a long-term or a buy and a hold cash position. Those type of brokerages obviously will be much better as you churn 20% every month. Another question, what has been the maximum drawdown of Gulaq Gear 6 portfolio? That's a great question. I'm going to see if my team can pull up that data directly. But just looking at it visually, I would say the period towards the end of last year, around November, to the period of around March of this year, we did have almost 10-11% drawdown. And that was probably order of magnitude the largest part of down performance we have. Okay, could you throw some light on expected alpha based on backtesting results? I think I already covered this. Historically, the outperformance that we have had over long periods of time would average about somewhere between 5 to 10%. But let's say the expectation we would have based on our historical performance would be about 6% is what we should be able to achieve on an ongoing basis. Again, subject to market conditions, nobody can predict what will happen in the future. With respect to strategy, protecting on downturn, strategy goes to cash or something else. The way we have created these portfolios, each portfolio has a certain asset allocation. So Gear 6 will be invested in equities 100% of the time. Gear 5 will be invested in equities 80% of the time. It does not change its allocation in terms of exposure to equity based on month-to-month changes in market. It does not do that. You should, if your risk tolerance goes down, should maybe do your asset allocation in a different way, rebalance on what you want to expose to markets or to fixed income. But Gear 6 is 100% allocated to securities and stays that way. Pratik Tambe has a question, how can we avoid slippage charges? This is an important question. There are a couple of sources of slippage that would happen. One source of slippage is timing. We provide the rebalance at the beginning of the month every year. The investor then has to click and execute those orders in the market through their brokerage firms. If you wait a few days to execute, for example, if you haven't done your rebalance for August and don't do it, let's say till this weekend, you are almost 7 days into the month, which is 25% of the month, and you haven't adjusted your portfolio. That can take away a very significant part of your performance, because the markets, if we are right about selecting the securities we have selected, would move in a way that going into those positions later will give you less return than going it immediately when the rebalance is available. So the first thing you can do is promptly act on rebalance as it is introduced and made available on your portfolio. The second thing, obviously, is you've got to watch on how your brokerage firm is able to do it. These things are fully automated. When the orders go, they go in totally into the market, and there should be no slippage. But again, experience could be different in different brokerage firms. We don't have a direct way of tracking that. That's an experience you can share. And if you're willing to share with us maybe your actual portfolio experience, we are happy to do some analysis and share with you if you can do better. How do you manage allocation between large, mid, and small caps? This is a good question. One of the things on the chart I am showing you is which part of the market did well. So as you can see, the first column is the biggest stocks, which is the Nifty 100. The next column is the mid caps, which is the next 150 stocks. And the final column is small cap. Now, if you look at the green color, that is what performed well in every year. As you can see, a lot of green towards small cap. So small caps generally outperform mid and large cap, but not always. 2022, for example, small caps did worse than large caps. And every now and then, maybe half the time, small caps don't do very well. So we do not explicitly target one or the other market cap segment. If you look at the rebalance data, here is what our allocation looks like for August. We have about 13% in large caps. Bulk of our portfolio is going to be in mid caps, and about 30% of our portfolio is in small caps. That's where it is today. Generally, we are probably even more in small caps as we were about beginning of the year, and that has performed very well for us. We were not as much in small caps last month. But this is an outcome of what comes out of scoring 130 factors and building the portfolio bottom up in a balanced way. We do not explicitly try to control whether we're going to have more small cap or large cap. How do you manage the allocation? Well, we covered that. Do you have lower exposure to financials? Why? Again, we build the models bottom up using the scores on the 130 factors that we score on. That does result in different exposure to sectors. So on this page, you can see financials is about 25% of the BSE 500 index. In July, we had a zero exposure. In August, we have about 17% exposure to financials. Similarly, industrials is a 10% of the overall index. We had almost 36% exposure to industrial last month. That's coming down. We have about 16% exposure in this given month. So this is an outcome, again, of our model building portfolio exercise, not something that we explicitly control. Is small case Gear 6 better than PMS if ticket size is more? Over long terms, we expect that the PMS product that we have, which has a minimum investment of 50 lakhs, will perform better and more stable than small case. Simply because to fit the needs of a smaller investor who's not investing 50 lakhs, in small case, you can invest with as little as 50, 60, 70,000 rupees, which is very different than 50 lakhs that you need to invest in the PMS product. Now, to be able to create a balanced portfolio, we need to have smaller number of stocks when we are giving a small case portfolio. So typically we hold position in only 20 to 30 stocks out of the 500 in the universe that we are trying to pick the stocks from. Whereas in PMS, because we have 50 lakhs to invest, we typically hold positions in 50 to 70. So we build a more diversified portfolio, and it is likely that that diversification will help over long periods of time, reducing the volatility and improving the returns. However, in the last 2 or even 3 years, our small case portfolio has performed much better than PMS. And that is primarily been because some of the large caps have way outperformed the small caps. So there has been relatively little benefit in having more small caps, more names in your portfolio. You have done better by simply taking some of the large cap names and performing and having the portfolio using those. What's the strategy of Gulaq 6 for downside protection? Does it go to cash or something? I think I already addressed it. Does not go to cash. It stays 100% in equities, which is what our mindset is. And investors should be adjusting their allocation. If they want to use us to do that, then the right way to invest would be to invest in gear 5, 4, or 3 as your risk tolerance takes you down. If you see that the markets are very volatile or may be going down, don't get 100% exposure in equities, invest in gear 4. There's another question. I requested Vivek sir to share back-tested results for gear 6 in the last webinar, but the same is still awaited. Could you throw some light on it? It's a great question. I did not know that that was a question, but we can probably see if my team can email it to me, and I will try to show that to you. Why don't we have gold in Gulaq portfolios? Gold over long periods of time behaves closer to fixed income. So the returns on gold portfolio over 20, 30, 40, 50 years is similar to fixed income. There have been periods in last 10, 15 years where gold has done exceedingly well, but there were periods of 20 years where gold did not do much at all. So we believe gold belongs in the portfolio potentially as an alternative to your fixed income allocation. If you're going to hold some money in fixed deposit, you could potentially hold it in gold and you'll get about similar returns over long periods of time. We don't hold it directly because we invest in either fixed income or stock market portfolios. How to invest when the markets are all the time high? This is the problem when people are trying to time the market. As the saying goes, timing the market is not the way. Time in the market is what is important. So the more you invest every month and stay in the market through ups and downs, you will do better over long periods of time. We know our economy in India is going to go to 5 trillion, become the third biggest economy in this decade. That will happen. If that happens, then the stock market overall will continue to grow. But if you try to time it and this month I'll go in, that month I'll come out, it's unlikely that you can do it precisely, and it's more likely that you will lose money. Conceptually, returns on small case Gulaq 5, for example, do not account for brokerage fees, which is quite high with the constant rebalancing. Any thoughts on how to control this? As I mentioned, we think that it is much better for you to be on a discount brokerage or at least on a plan with a brokerage which really gives you a low brokerage per execution. This is a high churn strategy. And if you're paying high commission on every trade, you are not likely to make any good returns. So please either be on good plan with your brokerage where you have zero or very, very low brokerage, or with a discount broker. There are several of them where you have zero brokerage. Of course, you have to pay exchange fees, SEBI fees, and other things. But with accounting for that, you will make good enough returns, plenty of returns to not have a problem. Any plans of launching mid or a small cap fund? We believe that the investor's life should be made simple. So small cap fund is a theme investment. You are believing that small cap will do better. As I showed you, That's not always the case. In this chart, you can see about half the time small caps didn't do well. Now, who can tell whether 2023 is the year where small cap will do better than large cap? Certainly we cannot. So we do not focus on just one sector, and we don't think that it is our job to make the lives of an investor more complicated by having them to choose whether they should invest with us in a small cap fund or a multi-cap fund. We think the only decision you should make based on your risk profile is how much risk I should take, which means what is my gear of investment? That's it. We don't want you to be worrying about which theme to invest in. So we do not plan currently to launch a small cap fund for the reasons that I just articulated. What is a reasonable amount to invest in gear 6? I think, as we mentioned, you should invest, obviously, the minimum recommended amount, which depending on the gear is somewhere around 50,000, maybe lower for gear 6 and higher for gear 2. But if you keep investing on a regular basis on your asset allocation, then your performance obviously will be more sustainable and your kind of rupee average into the market. Shubham Meena has a question. I am incurring double charges from small case due to separate rebalancing and repurchasing. Can you combine these transactions to avoid multiple charges? I am frankly not sure what you mean. I guess what you mean is you first need to sell some shares and then you need to buy back some other shares. I don't think, unless you have excess money, let's say you have 25% excess cash in your brokerage account relative to what you have invested, then you should be able to do the whole rebalancing in one go. But there is no way to avoid that if the total amount of money is there, because when you sell, you create cash, which takes 2 days. Then you can buy using that money, the new positions that you need to buy. But I'm not sure that you are spending twice the money. If you are, please put another comment because we think even if you were executing all these transactions on the same day, if you had excess money in your brokerage account, the total amount of brokerage or cost you will pay is the same. Unless I'm missing something, if I am, please put it in the comments. The ETF portion of my Gulaq 5 is out of bounds due to some kind of C side attributed to trading partner. I already have had KYC completed on individual, both with NSDL and CDSL. Neeraj, let's follow offline. Please connect with us via email, which is there on our website, or connect with us on our social media platform, which is here. And we would like to understand this better because I'm not exactly sure what's going on with your Gulaq 5 investment and why is there a problem with your ETF investment, and we'll happily get into it in more depth. Okay. Gulaq ever be planning to release product which focuses on intraday swing trading to generate more returns? Do you consider business sector while selecting stocks? We don't think that the retail investor product, the way it is envisaged right now, can effectively work in the intraday market because the execution slippages are just simply too much to effectively play the intraday trading market. ST is a market maker. We do have HFT capabilities. We trade very significantly in that market, but that requires a tremendous amount of automation, algorithmic capabilities, co-located servers, market data. It's a very expensive proposition, and it's not the right strategy for retail investors who are going to try to do this in potentially manual manner. So no, we don't think we'd be releasing anything which is intraday trading anytime near. There was a report that SEBI released that 90% of derivative traders lose money when they trade actively in derivatives. So we don't think it's a really good investment proposition for retail investors. Our products are meant for investors who want to make their investment life simple, who don't want to actively be looking 5 times a day on what to buy, what to sell. That's not the product that we have created or are planning to create for retail investors. Do you consider business or sector cycles while selecting stocks? Yes. The 18 macro factors that I mentioned are all about what business cycle it is, what has been the growth rate, inflation, interest rates, energy prices, gold prices, everything is considered. So that is explicitly part of our model creation. I want to start SIP in Gulaq 6. Then what is the right day for SIP? Well, I think the right day would be the beginning of the month, because we provide the rebalance every first of the month. So if you balance, your money will be invested on the most effective day to put money in. What should be the minimum net worth for Gulaq 6 recommended for 2 to 3 years, keeping in mind all expenses for brokers and fee plans? I guess you are asking what is the minimum investment. Well, technically, you can invest, as I mentioned, depending on the gear, with somewhere around 50,000, a little bit less, a little bit more. But I think realistically, the smaller the investment amount, the more is the rounding error on how much of a position you are holding. So if you were investing about 2 lakhs, I think you would be in a good position to not have too much of a model error in what you have invested. So the backtesting results, my team has told me, were available in the small case fact sheet. However, they have been removed by small case. We will provide the backtest results in the YouTube comment section, and you can see the results there. So please watch out for that. Are small case stocks selected on basis of fundamentals and technicals, or both? Are there other parameters as well? Yes, both are definitely included. And there are 4 more. We look at whether the stocks are part of what indices, Nifty 50, Nifty 100, Nifty 200. We see whether mutual funds and other investors are buying those stocks or selling those stocks. We look at even factors like what is the impact of macroeconomic conditions on different sectors. All of these things are included besides the fundamental things, which are looking at their financials, or technical things, which are looking at the price and volume action in the markets. I am currently invested in Gulaq Gear 6. I want to invest more in this small case. What is the best time to increase investment in it? At the time of rebalance or whenever market is down in the month? My recommendation would be at the time of rebalance. I think it's very difficult to predict when the markets will be down or up. It's possible that you invest when the markets are down and they go further down. At the same time, it's possible that you're waiting for the markets to go down and you missed all the upswings. One thing to keep in mind is a very large part of the stock market returns come on very few days. And people who try to time the market tend to miss those big up move days. Because you're kind of watching, okay, I'll invest when it's not going down or it's not volatile. And then suddenly there is a week, 3 days in a row, it's up 3%, 2% every day. And you are already missed out on 10% of the return. Now, you only expect to make 12 to 15% in a year. If you miss out 5 to 10% in an up run, it's very possible that you have missed out the whole action that you're going to get for the year. So best time to invest is just around rebalance. I'm doing all the transactions in the same day on each rebalance. I'm adding more money as I'm doing SIP. So I have to do double transaction, one for rebalance, second for addition. Oh, I understand. That's a good question. I cannot answer it right away, but we'll think about it and we will provide the answer in the comments. Again, I'm going to wait for my team. If they can tell the answer, then I will give it to you. But I understand what the question is. So let me think about that a little bit. Okay, I do have the I guess the backtest results here. At least for 97 months of backtest. So let me pull that up once. These are the backtest results over 97 months that we have put in there. The blue lines is Gulaq, orange line is the BSE 500. We have been live in this model since May of 2000. So this is going back from about 2008 onwards. Okay, there is another question. Can we hedge Gulaq portfolios? Of course, you can hedge Gulaq portfolios by going short on a nifty future, but that would be replacing the stock market returns. As we said, stock markets over long periods of time likely to do, let's say, 15% a year. Our portfolio may do a little bit better based on historical data. So let's say it may be doing 20%. Now, the better part is 5%. If you hedge using, hedge the portfolio, your return will be 5%. So you are replacing the likelihood of making overall the period of time 15 to 20% with a likelihood of making 5%. So I'm not sure why you would do it, but technically you could do it by simply shorting a nifty future. There is good news. By the way, all the people who are here, we have a discount going on right now. It's called August 20. You get 20% discount on 3 to 6 month plans on all Gulaq portfolios. It's for first 100 in subscribers till August 31st. So feel free to invite people or otherwise take benefit of this price reduction to try out the product. Okay. There was one more question on drawdowns, and my colleagues have put that data up there, so maybe I can share that with the team. These are the drawdowns. So the blue line is the drawdown of our product. The red line is the drawdown. Orange line is the drawdown of the overall index products. So periods where the blue line is below the orange line is when we had more loss than the benchmark. So as you can see, there are periods where we do underperform the index. That happens. So if you have expectation is you will always be doing better than the benchmark or the index, or you'll always be making money, neither of those things are guaranteed or possible. So we do go through months where we underperform the index, and we go through months where we underperform, meaning we have losses and we are negative in the market. Okay, I think I have covered everything. So if there are more questions, I'm still going to be here for a few more minutes and we can keep doing the questions. Let me invite you to join, follow me. Here is the LinkedIn profile of Vivek. There is the Gulaq social media presence. You can also connect with me, Sandeep Tyagi, on LinkedIn and Insta. And we'd be happy. We all monitor our social media properties. And if anybody has any comments or questions, we try to be active and answer questions there as well. So you could do your own personal Ask Me Anything anytime. Okay. Right. There's another question from Long Voyager saying, what's the expected and historical dividend earnings for Gulaq 6 portfolio in terms of percentage of return, overall returns? I don't have that number top of my mind, but my expectation of dividend return is between 2 to 4%. So out of the overall return profile of, say, 15 to 20% over long periods of time from Gulaq Gear 6 based on historical performance, roughly speaking, 15 to 20% of it will come from dividends, is my expectation. So let's say 10 to 20%. Okay. There's another question from Avinash. How does backtesting done? Tell about performance. How is it carried as a concept? I shared with you the backtesting results just now. We do backtesting for a period of almost 15 years. We are constantly testing new factors, new ways of investing in the stock market, and testing those factors, not just how they would do now, but how they have done over a 15 plus year period. So once we do the backtesting, then we observe those factors in the live market for some time. There is a problem in algorithmic training that's called overfitting. That means if you give me any historical data, I can always find a pattern that will tell me if you had done this, you would have made a lot of return. By the way, that's a lot of what technical analysts do. They look at what happened yesterday or last month, and then they come out with a back-tested theory and say, if we had only done X in the last month, I would have made so much return. Problem is that X doesn't work next month. Next month, Y works. So this is the problem of overfitting. Whenever you are trying to make precise calculations of what worked in the last month, you will always make mistakes. So we backtest, taking care of not overfitting, finding patterns that are simple and always true, and then observing them in the future, seeing that they are still working well, and then keeping them in the portfolio if they continue to do well. If I do one-time investment, do I need to do SIP or invest only when I have significant amount available again? The benefit of investing, obviously you have to have minimum amount needed to create the portfolio. That's why we have a minimum amount. Then after that, it's likely to be better for you to keep investing every month if you have the SIP additional savings. If you keep the money somewhere else, the question is, where are you keeping it? If you're simply keeping it in your checking bank account, then you're not earning much return on it, maybe 2-3%. The expected return on stock market is much higher. So going into the markets on a regular basis as you save will make a big difference. Look, overall fixed income versus stock market over long periods of time maybe only produce 4% more return or 5% more return. But over a period of 40 years, which is what a typical saving lifetime is, you start saving maybe when you're 25 years, and you save till you're working, maybe till you're 65 years. Over that 40 years period, the amount of difference will be 4x if you invested in constantly stock market versus fixed income. So staying in the market and regularly investing is the right way to build the right good corpus. Can Gear 6 be also good for retired individuals, or do you recommend debt products over Gear 6 product? Well, it depends on two things. What stage of retirement you are in. If you are, if you're 85 years old, 90 years old, and you have sufficient money to pay for your, next 5, 7, 10 years of investment, then Gear 6 is not the right product for you. But if two things are true, one, you have plenty of money. There are people I know, let's say my mother herself, she's 90 years of age. She has significant amount of savings, which she is planning to leave to her children. So for her, investing in Gear 6 is appropriate because she has enough money. Even if the stock market goes up and down, the money is not supposed to be used in the next 1, 2, or 3 years. So she can afford to be in Gear 6. But if your money is just enough for what you need to do your lifestyle and what you need to spend, you can't take the risk. Because if the markets go down 20, 30%, then it means you cannot spend that money on what you need every day for your living expenses. Not a good idea. So if you have more time, more than 10 years, stay 100% in Gear 6. If you have more money than what you need, let's say 2 to 3 times, 2 times more money than what you need in your expectation, then stay in Gear 6. If either of those two things is not true, then start reducing the gears. Now, you may have gear 6 with us, but that may be only 10% of your overall savings. So effectively, you're gear 2. You may have lots of fixed deposits, annuities, and other products that you are keeping outside Gulaq investment. And then gear 6 investment is okay, because you have to look at your portfolio overall, not just what you invest in gear 6. What is your overall asset allocation is what is important. Lavraj Tyagi is asking, getting started in the Indian stock market. Great, welcome. You should invest. There is a Lavraj Tyagi who's my relative. I don't know if that's the same person, but absolutely get started. Start investing regularly and you will do fine. Rajit Dumer, how do I choose between gear 3, 4, 5, 6? This is the most important question, and I talk about it all the time. Gears reflect your ability to take risk, your aptitude for taking risk, your emotional makeup to take risk, and your financial situation. Younger people who are earning well and don't need money immediately should stay in gear 6. Older people who are no longer earning and are relying only on their savings and have just enough savings for what they need should stay in gear 2. And that continuum goes from gear 2 to 6. This is overall investing. If you are investing just with us, that's what you would do. But if you are investing with multiple people and you have some investments in fixed deposit with your bank, you have a investment real estate property, you have some gold, then you should think of the overall picture. And if in the overall picture you have other investments which are appropriate, then staying in gear 6 is okay for you. So that's how to think about gear 2 to gear 6. This is the right way of driving your savings car. Gear 2 is appropriate when the situation is tricky, there isn't enough money, enough savings, and time is less. You want to be cautious. You want to be gear 2 investor, which exposes 80% of the money in fixed deposit and only 20% of the money in stock market. On the other hand, gear 6 is 100% in the stock market. So if you have 80% of your money in fixed deposit and only 20% you're investing with us, it's okay for you to be in gear 6. Okay. Jagdish has a question. Why do FII, DI follow opposite? One buys and the one sells on the same day. Well, that's going to be always true. Somebody's going to, every stock that is sold in the market, somebody else buys. Every person who's buying is buying from somebody. So there'll always be somebody who's buying, somebody who's selling. And depending on conditions, a typical FII may have global considerations. They may be looking at their global allocation, looking at macro conditions in other markets versus Indian markets. And a domestic institutional investor is probably focusing on their domestic evaluation of what is happening. And these things can vary. It may be that India is doing fine, but India is not doing as well as potentially some other markets, let's say like US or Europe or Japan. So a foreign investor may allocate more or less to India at that time, whereas in that case, they'll become net seller in India. And somebody has to buy. So domestic players will continue to build. So that's why these things change. There isn't any conspiracy. There isn't any specific plan on why foreign investors do one thing versus it's their needs. It's their goals of how they optimize their investment portfolio. Umesh has a question. How much percentage should I allocate to gear 6 amount for a month? It depends on your overall allocation. I think we have talked in several different answers on how to think about asset allocation. Think holistically over your whole portfolio, not just what you're giving to Gulaq. It's your overall asset allocation that's important. And then decide how much to give in gear 6 versus gear 3, 4, 5. And by the way, the answer will not just be for Gulaq. It's your overall risk tolerance and overall allocation that's important. Avinash has a question. How does backtesting? Oh, I think we covered that. I want to invest for 2 years. What is the market look for next 2 years. I don't have any special insight about next 2 years. I'm sorry, Manmoy, but stock markets over long periods of time have done well. And all indications are India is a growth economy, will continue to do well. And you are likely to do better than keeping your money in fixed deposits over long periods of time, but not on a year-by-year basis. Even on a 2-year basis, you can lose money if you invest in stock market. There have been periods of 2 years where markets have been down from when you invested. So be prepared for that and be ready for investments over long periods of time. It's a question from Umesh. I'm a software engineer, currently work from home, getting 1.4 in hand with no expense at all. How much can I allocate to Gear 6 per month? Umesh, you haven't mentioned how young you are. I assume if you are a young person, let's say 30 years of age, and you have another 30, 40 years of working life ahead of you, you have no expenses, you should be going all in for stock market investing. Now, your emotional makeup is important. If you are ready for a period where the stock market goes down 10, 20, even 30%, then you should be in Gear 6. But if you're going to panic, if that happens, and say, oh, toba toba, never more I'm going to invest in stock market, then don't be in Gear 6. Then stay in Gear 4, 5, 3, lower based on your aptitude. But from a need perspective, somebody who has good amount of income generation, they don't have any expenses, they're young, they should be investing in stock market. Now, the other thing is diversification. It's good to invest in stock market, but just investing in Gulaq, you are not diversifying provider risk. Gulaq is one company. So you can choose between 2, 3 different providers, maybe if you like some other fund provider, and then allocate between them. That would be sensible for you to do. Is there any risk of complete loss of capital in Gear 6? I would say it is the only way that can happen is if stock market were to, or the 30 stocks that we allocate to, they all were to go to zero value. That has not happened in the history of stock market. Can it theoretically happen? Yes. That risk kind of always there. As company go bankrupt, they become worthless. But could that happen to all the 30 stocks that we have? I think the chances are near zero, but theoretically possible. Is there Gear 6 okay for ticket size of 25 lakhs? Yes, absolutely. It is absolutely fine for ticket size of 25 lakhs. We do have a slightly broader, more diversified portfolio, which we call Gulaq Wealth, which is more diversified than Gear 6. And that may be better for investment of 25 lakhs over long periods of time. Gaming zone. Is it a good idea to buy long-term put option to avoid big drawdown? Drawdown shakes the confidence to keep investing. Yes, we have tested this. This concept is called portfolio insurance. You can find ways of doing it, but net the markets are reasonably efficient, and what you will pay in premium is probably overall the same amount as you will get in protection. So a better way for you to hedge your emotional state is to not, first of all, don't think of your equity investment as standalone investment. Think of your overall investment. If you're putting 20% of your money in Gear 6, 80% you're keeping in FD, you're already doing a Gear 5, right? Not with Gulaq, but you are doing it with your bank. Let's say HDFC has 80% of your money in fixed deposit. 20% is with Gulaq in stock market Gear 6. You are a Gear 5 investor. I mean, actually a Gear 2 investor, because 80% is in fixed income. So you are not going to have a lot of loss. It is possible that Gulaq part will lose a lot of money, but overall you won't lose a lot of money. So that's how you need to think. You can't just be looking at your investment in one piece. That's not the right way to look at investments. While on the day of rebalance of Gear 6, how many percentage money more required to rebalance? Please answer. I want to invest lump sum amount. We rebalance about 20 to 30% every month. That means you would need to have enough money roughly speaking, about 20% more than what you're investing with us to be able to do everything together. Okay, well, great. We are getting a lot of questions. We are just over 7 o'clock. We will continue till we are getting questions. So keep them coming. Okay. Rab Prasad Gurai has a question. Suppose I have invested 2 lakh via Dhan broker and I will do 10,000 monthly SIP. What will be the small case charges excluding tax? That's a good question. I'm not 100% sure directly of the answer. So the money it does not directly impact your fees. You buy a Gear 6 investment subscription, which is a fixed fees for 3 or 6 months. And as you keep investing, that's okay. You don't have to pay more to us. Avinash so you will pay whatever is the 6-month charge for that gear. And if you're using a discount coupon, you'll pay less right now. So it depends what plan you have. The amount of investment that you're doing does not change that fee. Avinash Khare 128 has the reason of SEBI keeping 50 lakh as minimum amount for PMS investment. That's a very good question. The general feeling is that for a retail investor, the product that they want to encourage is mutual fund, which has a minimum investment of say 500 rupees. They give more latitude to PMS investors to do different kinds of things. And the advisors to PMS are less regulated than mutual fund companies. So in SEBI's mind, PMS advisors are supposed to work with investors and give them special advice or treatment of products. And they don't want every retail investor to be doing that because, historically, if you're not very heavily regulated, some people take advantage of investors and they want to protect the small investor if they don't understand what the PMS provider is doing. So in a mutual fund, what you're doing is very tightly controlled by the regulator. If you say I'm running a benchmark fund against a multi-cap, you can only invest in that and so on and so forth. So that's why the minimum investment is at 50 lakhs. What's the reason? Okay, we answered that 50 lakh question already. Yeah. Okay. Please take benefit. Feel free to encourage others you might know to take benefit of this discount coupon. Follow us on social media and stay tuned. We will keep doing these webinars and ask you anything frequently. And you can ask us anything on our social media properties as well. Okay, we are 5 minutes over. We're going to stop here. Thank you so much. And have a good night and take care. Happy investing.